All right, so it's 2:05, and I think it's a good time to start, especially for the attendees who joined us exactly 2:00. Thank you all so much for registering and signing up to listen to this webinar, which is brought to you by CESO Global. CESO is Africa's global property marketplace. What we do is that we provide advisory services for individuals who want to do anything related to property. Technically, we hold your hand through every single stage, be it the property search, due diligence, if you need a legal opinion, whatever it is regarding property in Africa, specifically Ghana, Nigeria, and South Africa, that is what CESO does for you. Today, we're going to be talking about building wealth through real estate. Now, everyone knows that real estate is an asset that is valuable and has the potential to appreciate not only within your lifetime, but also in the lifetime of generations to come. So it's no mystery that people spend probably the largest amounts of money in their lifetime on property. And today we are joined by two experts who are going to tell us how to build wealth through real estate, how to capitalize on the real estate investments you already own, understand how you can appreciate what's going on within the market and investment vehicles that leverage off real estate also. With us today, we have Dr. Navid Ahmed and also Dr. Susie Owusu. Before I introduce them, my name is Danswa. I am head of sales for CESO Global. And I'm going to tell you a bit about our speakers that we have with us today. So Dr. Susie is currently the CEO and wealth manager at Octane VC Limited, a fund management and investment advisory company licensed in Ghana. Dr. Susie's path in investment banking began in the year 2004 when she joined DataBank Asset Management Limited as an investment analyst. Rising through the ranks, she became head of private wealth management unit and eventually the vice president of the same unit. In 2011, she became the principal in charge of wealth management at Oak Partners. And in a matter of 3 years, she had been elevated to partner of wealth management. In 2017, Dr. Susie incorporated and managed her own company called Octane SD Limited, a fund management and investment company, which would later merge with Dalex Capital Limited and metamorphose into Octane DC, which is the company she heads right now. This was in November 2019. By 2021, the total value of funds managed by Dr. Susie stands at circa 400 million Ghana cedis for high net worth individuals, institutional clients, and mutual funds. Pension funds and portfolios were also managed under her tenure. Dr. Susie also serves as a lecturer at the Ghana Investment and Securities Institute and also at Central University Business School. She is a fellow of the Association of Chartered Accountants and an associate of the Chartered Institute for Securities and Investments in the UK. Dr. Susie is an alumnus of Walden University in the US, where she earned a doctorate of business administration in wealth management. And as a foundation, she holds an MBA in finance from the University of Ghana and a BA in economics and sociology from the University of Cape Coast. And she's an alumnus of Maoli Secondary School. She loves to give back, and for this reason, she serves as a business mentor for Ashesi University, and she also mentors young women who are looking to grow in their leadership and their communities. So that's it for Dr. Susie. Dr. Susie, thank you so much for joining us today.
Thank you so much for your kind introduction, Danswa.
You're welcome. We also have with us Dr. Navid Ahmed. He is the founder, principal, and SEO of Imani Wealth Management Limited. Prior to the establishment of Imani Wealth Management in 2021, Dr. Navid worked at Bank Julius Baer from 2019 as managing director and group head of Sub-Saharan Africa to March 2021. He has also been the SEO of Namara Wealth Advisors, a multifamily office regulated in both the IFC Dubai and Singapore from October 2017 to 2018. Dr. Navid Ahmed was a managing director of Credit Suisse in the private banking and wealth management division based in Dubai. He was the global market leader of Sub-Saharan Africa coverage teams. He was also the head of the Sub-Saharan Africa and Pakistan coverage team in Dubai. He joined Credit Suisse in October 2013 and left to become SEO of Namara Wealth Advisors Limited in October 2017. Dr. Navid was with UBS London from 2006 to 2013, where he was managing director and team head of the emerging markets team, including key client coverage. He also worked at Citigroup Private Bank London for 11 years within emerging markets as a managing director and senior relationship manager with a focus on Sub-Saharan Africa and Pakistan. From 1991 to 1995, he was with Citibank London and Pakistan within the global consumer banking business, where he set up, established, and managed the non-resident Pakistan business desk for Citibank in London. Prior to that, Dr. Navid was a medical doctor. He switched careers into banking in 1991. Dr. Navid holds an MBA from Imperial College in the UK and an MBBS degree from Dow Medical College in Pakistan. Dr. Navid, thank you so much for gracing us with your presence.
Thanks, Danswa. Thanks very much.
So as you can all see, we do have two individuals who have extensive experience in the wealth management space and also experience in emerging markets. So we're going to go straight in, and our first question goes to Dr. Navid. What has been your experience with real estate investments in emerging markets?
Well, for the audience and panel members, I think it's the challenge we've all had as wealth management, or used to be called private banking in the good old days. Now it's called wealth management. When I started my career, there were three asset classes. It was cash, fixed income or bonds, and equities. And over the last 10, 15 years, it's morphed now into 8 or 9 asset classes: cash, fixed income, equities, property being an extremely large asset class now, and sub-asset classes for properties. Then we have foreign exchange, there was commodities, there was private equity, and basically hedge funds. All became new asset classes as people wealth improved, people diversified out of other asset classes. But in answer to your question, what I've noticed, I'm looking at predominantly Africa or sub-Saharan Africa and the subcontinent. By that I mean Pakistan, India, Bangladesh. Similar sort of situations where I feel as sort of the middle classes over the years basically became more affluent, or the level of affluency basically increased. Currencies and people are earning, people also left countries, moved out to UK, to the US, to Europe, from our regions, from Africa and from Pakistan, followed typically some of them the old Commonwealth routes, as they would call it. Started earning, more educated as time went on, earning power increased. They basically started investing a lot of their money in real estate. It was actually a hedge for them, which I look at when I look at locally, against inflation that happened locally in their countries, devaluation of their currency, which actually happened. I look at Nigeria, an absolutely phenomenal over the last 10 years, if you see where the Naira was to the dollar to where it is today. So people in property who invested in property actually made back, but property values managed to basically roughly take care of that deval risk, and in dollar terms remain somewhat comparable to what they basically had offshore. I think that's where I see a lot of real estate investment, a lot of people becoming more discerning, requiring more demanding. I think the quality of real estate's improved. So whether it be residential or commercial, I think that is basically what's changed. So it's become your own home was your first purchase typically as you started earning, and either you went and you rented or you bought. But people bought property as basically as a security for their children, or security basically as investment, as an income generator, as a capital gain provider. And I feel that's where the asset class has developed. If you ask me, back home in Africa, Nigeria, Ghana, and other countries, South Africa, or basic places back like in India, Pakistan, and Bangladesh.
Yeah, I completely can relate to what you're saying, because I think in Ghana, it was in about the year 2000 that people really started to invest in real estate, like buy it as an investment vehicle, as opposed to just building a home where you're going to live in. And now it's probably one of the most well, I wouldn't probably say thriving, but one of the largest growing industries is property development. You have so many people going into property development apart from established companies. You also have individuals who are looking to get into that space as well to reap the benefits that real estate can give. Dr. Susie, is there anything that you would like to add to that point?
Yes, I align very much with what Dr. Navid has said so far. Over the years, the traditional form of investments that you'll find in a typical client's portfolio are money market instruments and the stock exchange. It got to a point that we didn't have more options in terms of variety, so people began to look for something else, something innovative and something different, and something that could also preserve your investment, especially if you're earning hard currency. So that has been the appetite over the years, that people were beginning to look for something else. In our market as well, the approach to property ownership was more of my first home, let me acquire land and build a house. So that has been the focus. But now all those has changed. People are looking at property as a form of investment, buy, hold, rent, make some money off it. So that has been the trade. What we are lacking are part of our market is structure. Structure that allow everybody else to be part of the story. So every now and then, if it's not owned by you alone, then it becomes very difficult for you to put significant money into. So that has been the trend in Africa, especially in Ghana as well, where clients are looking for options to participate and to also hold on to something that they can have value over the long period. So it's a certain sentiment in Ghana as well.
People are looking for structure. Well, we always see these obstacles as opportunities. That's just an opportunity for anyone out there to try and bring some structure or some sanity into the system. And I would say first, before I go on to my next question to our audience, please feel free to leave a question in the chat box if you do have any questions. Thank you once again for joining this webinar. My next question is for you, Dr. Susie. And leveraging off your last point about structure, you are into the wealth management space in Ghana. What opportunities are there, structured opportunities are there for individuals in real estate, well, structured or otherwise? What opportunities do you generally see are available for individuals?
Thank you, Dansua. Largely, the opportunity depends on your capital outlay. Investment in properties requires significant capital, or you have some sustained income inflows that can also influence the choice of properties. So when you come into our space, the acquisition or the investment approach could be in various forms. It could be direct, it could be indirect. Direct as in you owning it all by yourself, or it could be through a pool, through a joint venture collaboration, or through a private equity fund. But for all of this, it's also informed by how much money you have and how long you are able to let it stay in the investment. Because when it comes to property, we are looking at someone who has at least up to 10 years, patient capital to be able to stay in and wait for the significant returns before they step out of the investment. So it's largely informed by the size of capital you have, or the size of expected regular inflows that you can come in. In our market, for instance, one of the areas that is very active is joint venture approach to property acquisition. Because we have an issue with land tenure, your safest approach is to look for someone who has claim title to land and you match it with your capital. Then there's joy, you know that you will not have any issues so far as land tenure or land title is concerned. So that has been one of the most popular approach, where there's a JV approach to investment in property than a direct acquisition. The other approach is through the PE companies, the private equity companies that are focusing in properties, be it commercial or residential, warehousing, shopping mall or whatever. So the PE approach is also another one, but the challenge with that is the minimum participation capital. So that has been something that is difficult for some individuals to participate in. For instance, if they say the minimum ticket is $200,000, how many individuals will have that? So what we do as an institution is to pull our high net worth together in a court and we invest on their behalf. So that is also another indirect form. So that is for those who have some significant amount. We are looking at $50,000 and above to be part of those pool. In addition to that is also the retail outlay, where we have real estate investment trusts. But the challenge we have had over the years is we've had only one listed real estate insurance trust in our market by HFC Homes, that is now Republic Bank. But I must tell you, Dansua, that is more like a money market fund for us now. It is no longer meeting the needs of a real estate investment trust. But now, luckily for us in our market, the regulator has introduced a sandbox regulation guidelines to help the markets develop products that can be aligned to properties for individuals with smaller capital that still have some appetite to have real estate as part of their portfolio, to go through the REITs and also have something to hold on to as property. So everything you do in our market depends on how much money you have, how long you want that money to stay in, especially how patient you are to stay in and then enjoy the significant return over the long period. So that has been the approach, your objective of going in, and why you even want to have real estate as part of your portfolio.
Okay, so Dr. Susie, if I'm hearing you right, I mean, you can go into real estate investment if you have property yourself. So you could probably even start your own development or partner with a developer in a joint venture. But if you don't have your own property, there are vehicles like what you, the pool method you use with your high net worth clients, and then also the investment trust, and thankfully now regulation to widen that pot so that if you don't have 200,000 CDs available, you don't have your own property, but you do have something that you want to invest into the real estate economy, you are able to do that. Is that correct?
Yes, that is very correct. What we do as fund managers or wealth managers is to attract such opportunity from, let's say, the private equity companies. So they have an opportunity to invest in maybe a mall, and they need people who can stay in there for 10 to 15 years. So such opportunities are brought to us, and they interest us as institutions to sell it to our client that may be interested. But because the minimum ticket size is usually large, it's difficult to have just one client participating. So we go in as an institution, and behind the institution are these retail holders,
smaller contributions,
guide along the way. But it will interest you to know that some individuals don't like pooled investments. They want direct access to their investments. So you have some individuals that will still insist that I want to do this directly, I want to own the asset directly, I want to have title directly. So you have people who are also like that. But the others who understand that it's an investment. You are not buying to hold forever. You are buying it for an investment reason. The critical thing is you want to make return on your investment. So whichever way it is, whether it's direct or indirect, once the opportunity is there for you to earn something over the period, it's still a good approach to look at some indirect forms. So these are the popular ones: the indirect approach through private equity, or direct through joint ventures, where you are doing it directly with a landowner and you know you are ready for the risk. But the pool approach also helps to expand on minimizing the risk, because you are in there with other participants. If there are any surprises, it doesn't hit you alone, but everybody gets of it. Yeah.
All right. So what I've gleaned, another thing that I've gleaned is that real estate is for the patient. So it's not a, it's not a short-term investment. You must be prepared to, stick in for the long haul. So, Dr. Navid, on that, I mean, what do people need to look out for? How do they know that they are investing in the right property or the right fund, whether it's something they're doing themselves, a collaboration, or going through one of these investment vehicles like a REIT? I don't know whether with a REIT you have a say in what is being done, but what does an investor or an individual looking to invest in real estate, a beginner, need to look out?
I think thanks. And first of all, exactly what Dr. Susie was mentioning, just to elaborate further, I think when you buy an investment and you put a sum of money aside in your asset allocation, as Dr. Susie mentioned, money markets, you've got equity, and then of course now property, you always have, and when you put money with a bank, you don't go put it with XYZ bank. You understand the bank is good liquidity, it's got good service, it's got a good reputation in the market, it's got financially deep pockets. So real estate is the same investment. Choose the right developer, choose the right location, choose the right sort of structure, as Dr. Susie mentioned, depending. Each one has its own merits and demerits, pros and cons. Private equity is a long-term, a game of patience. Properties, you can be either speculative investors, so you buy something hoping to flip it, like Dr. Susie mentioned, not hold it forever, but like an investment, you hold it for 3-4 years, it gets developed, you pay a foundation, then the first floor payment, then second floor payment. By the time you reach the third floor, the price has gone up, and you flip that like they're doing in Dubai, and they got burnt badly, very badly in Dubai a few years back, and now again it's all back again. So you either have to have a speculative, patient approach, or you basically have to have a view where you buy into an existing idea, an existing development, which is income generating, has got the right kind of demographics renting, the right kind of people, the right kind of building, the right kind of asset. And these are, so you have to do your homework. I mean, the key, one other point I like to point out, which is key for clients that are not only investing in Africa or other countries, but who are investing from outside inward. So a UK-based person buying in Nigeria or Ghana, a US-based person buying into his home country, into Ghana or Nigeria, or say in Pakistan, you have to have the right, as Dr. Susie mentioned, a clean title. You have to have basically a legal charge that basically makes sense, that it's your property, that it cannot be taken over by anybody else, because everything in our countries, in the old style, are files. Now that needs to be digitized. That is a process that's going to go through, I think, in Ghana and in Nigeria. That is a big headache. I mean, in the old days, I remember I had clients, I asked for proof of their utility bill, and the clients gave me a utility bill with his great-grandfather's name on it from Nigeria. I said, where's your name? He said, I can't go. If I go to change it, I'll have to pay a lot of money and it will never get changed. So I said, that is the concept, unfortunately, which is there now. One hopes with digitization, less paperwork, clean title, better developments, better developers with deeper pockets, giving better brand value and whatever. The other key consideration when you buy real estate, like any investment, there are taxes. So you've got income tax potential, you've got capital gains tax potential, you've got inheritance tax. Now, it might not be relevant in certain markets, and therefore the way you own that asset is, are mortgages available, are loans available? If loans are at 3% or 5%, can I invest my money? I don't put in property with Dr. Susie in one of her portfolios to make equal or higher. Therefore, I can leverage my property, borrow from the bank, use less equity, and these are considerations an investor will always make. Do I put 100% of the $200,000 myself, or can I put 50,000 and borrow 150? If I'm doing it myself, or I go 50 with Dr. Susie's, I agree with the sort of a pooled investment, because you can buy larger, you diversify the risk, you've got more parties, and you can actually, everyone then is in the same boat, as they say. And you can then pick and choose what you want. You can push the developer, you can get the pricing in your favor. You can buy more apartments, get a discount like they do in the UK. You buy floors and you get 10, 15, 20% discount from the market because you're buying in a bulk. All the investors then benefit for that. So I think a consideration of ownership, what structure to own in, a consideration of taxes, are you affected or not affected? Forced heirship rules, do they exist in our countries or not? I know in Dubai, For Muslims in Dubai, there are forced heirship rules in property, but they've come out now with a foundation structure which does not come under forced heirship. So you can hold property in a foundation, which it's like a living will or an operating will. So, or trust, if you want to call it that way. So there are various ways. I would say you have to basically speak to an expert in the market, someone like Dr. Susie, who's sitting in Ghana, basically, what is the way of ownership? What is the way of my tax situation? And what are other people's doing? It's always not a wise idea to run after the block that's done the best, because that's probably already made the money, and it's already probably you're going to buy at the expensive. Let's say buy expensive, buy high, sell low. It's everyone's perpetual issue. The idea is to find what is next. What is the block next to the one that's done well? Is that the next sort of golden egg that I can probably invest in today, make my returns tomorrow, and be a safe investment? So I would say there are a lot of considerations. You need to tick a lot of boxes. It's a big investment. So I would always do it cautiously and do it in a patient manner and do it in a structured manner.
So Dr. Navid is just reiterating the fact that we need to be patient, but also talked about research. And that is extremely important. You need to understand the market that you are coming into and know where the market is going, not where the market is, because oftentimes you're moving out of that space, or like Dr. Navid said, that specific submarket has got to its peak as far as valuation is concerned, or as far as perception is concerned. So buying into that won't necessarily give you the returns that you need. So what's coming next? Where are people's interests going? And doing that will make sure that you're putting your money in the right place, where your money has the opportunity to grow, as opposed to it being stagnant or even declining. Dr. Susie, what are your thoughts on that?
It's interesting Dr. Navid has mentioned ownership and the approach to ownership in the part of the world that he sees himself. We have a very interesting title mentality here. You want to own it and own it for yourself, and it's just your name. So it's very difficult to, retail real estate opportunity to individuals. The point you made about flats, a group of people owning a floor. The approach is that I want to own it all by myself. So that makes it so difficult for a lot of people to come into this space and have it as part of their portfolio. So if we can get to that space where people are ready to share in the opportunity, that there's a flat that is going for $250,000, why can't we have 5 people own that? The opportunity is to have it as part of your portfolio. The opportunity is not for you to have it and move into, because you're already living somewhere. So why can't 5 people own a flat somewhere and work together to enjoy in the gains of that? If we get to that space, we'll have a lot of retail clients who are able to now own properties as part of their portfolio. Because the focus is to attract a lot more middle-level executives to begin to see portfolio managers as a critical resource in growing their wealth. One of the challenges we have in our part of the world is that everybody feels they can do it by themselves. So they see a high rise going somewhere, they see a property going up somewhere in a private area, they want to walk in there themselves, ask about it, and invest in it. What that presents is that you are in there for all the risk that comes with it. So if the ownership approach can change, then we should have a lot more people participating in that opportunity. The other one is also the structure, the finance structure. We live in a space where real estate is not that regulated in terms of an investment opportunity. So it's more of private initiative. So we usually start, when you start work, the first thing is to buy a land. So we all grow with so many land surrounding us. And the next thing you want to do with your last mortgage is to begin to build on that land. So it's largely private initiatives. So you have a lot of properties that are incomplete because you don't have enough money to complete it. So if the financing structure also is improved, then we'll have a lot more people coming in. to participate. So the risks or the challenges in there is all the mentality. And for me, very critical is for you to appreciate your objective of holding real estate as part of your portfolio. It must be so clean, it must be so neat. Why do you want to have real estate as part of your portfolio? You must be so clear on that.
Yeah.
And for me, to put money in and make money out. I don't want to just buy and hold. That is not the intention. I want to be able to buy, sell later, or buy and begin to earn income on it. So it's important that we understand why we are adding it onto our portfolio. In our market as well, that's why I mentioned something very interesting, research. A lot of us don't want to pay for research. A lot of us don't want to seek out information before we take the next step. So we must be able to pay for research in real estate opportunities. So someone, a platform such as CESO should be able to guide you as to where to go in terms of your own needs so far as buying real estate is concerned. So we must be ready to pay for research in making decisions when it comes to investment. The other thing for me is also knowledge, that you begin to pick out on a number of noises in the market before you make decision. We are moving out of just quantitative numbers. You don't want to just rely on the numbers in the financials and say this is good. You are interested in knowing the people who are behind the business, because you don't want to put your money into a venture that is all owned by a little family. Everything is between the father or husband and wife and son. It's just around them. There's no clear paths for succession planning or stewardship. So you get in there and then there are all these surprises that you did not anticipate. So picking out on the qualitative in terms of what the business opportunity offers is also a good way of managing the risk that is involved there.
Susie, you raised a very valid point, and I think Dr. Navid also talked about its ownership. And I want to add another aspect of it, which is like land tenure system and how legally you can own property anywhere, whether you're buying property in Dubai, Nigeria, South Africa, or Ghana. It's important to understand the ownership laws and for how long you can hold property, and more importantly, what you can do on the property. So Dr. Susie, you've alluded to the fact that the market isn't regulated. It isn't so regulated, but you know, sometimes when government wants to crack the whip, they do. And the last thing you want to do is to be found wanting, not knowing what you could have done on the property and probably have done something different. So if the area has been zoned for something commercial, then you've gone to build, I don't know, a residential unit or industrial or something like that. It's really, really important. And it does come back to the research and hiring professionals, if you don't know, to do it yourself, and even understanding, especially again for us as CESO, and I'm assuming a lot of the audience is from CESO's database coming from the diaspora or nationality. In Ghana, for instance, your nationality does have an implication in the duration of ownership you can have at a given point in time, you know. So it's important to understand that so that you can effectively, you know, match your investments with the timelines, your objectives, your anticipated returns. I see that a lot of times we, like with real estate in Ghana specifically, we always go with sentiments and emotion, and sometimes don't take a step back to look at the rationale behind what it is that we're doing. Do I just want to own a place, or I actually want to make a business decision? And I'm doing this because I can anticipate a certain return, as opposed to just being seen as someone who has a lot of properties. Because being in this space, the market in a lot of places is very tight. You know, there's a glut in some places. There's an oversupply in some places, and it's all because there wasn't a proper understanding of the things that need to come together to make the investments a viable one. So those are very, very valid points that you have raised. And of course, as CESO, our doors are always open to anyone who needs advice venturing into the space as an investor. And of course, we have support from the likes of Dr. Susie and Dr. Navid, who also have very extensive experience and can weigh in on the advice that we give. So what are some of the challenges with investing in real estate? This isn't a challenge per se for me, but I know that you require patience. So I'm assuming that real estate is a very long-term thing, at least medium to long-term thing. So probably starting with Dr. Navid, what are some of the challenges and some of the risks associated with real estate investment? And please don't forget to drop your questions into the chat box if you haven't done so already.
I think when I've seen, if you people who've been in investing over the last 20, 30 years, or in the last even 10 years, you have risks basically, which what we call in our technology black swan events. You just don't know. COVID. Who ever knew that COVID basically would come? Who ever knew that the world would stop? I mean, I'm not exaggerating. I landed from Nigeria in the last part of February in Dubai, and I was just going off to Lusaka in Zambia. 2 weeks later, Emirates closed. And my first flight I took out was exactly a few weeks back when I went to drop my daughter to the US. And that was literally a year and a half. I used to travel every month, and that's me going in. So it affects everyone. I look at all the developments. People lost their jobs. People basically, workers, especially who are working on a site, weren't being paid. Money could not be transferred because people who are investing, as Dr. Susie mentioned, who are paying basically installments, did not have jobs to pay. They stopped paying those installments. Suppliers basically stopped being paid. So it is a risk basically when you have economic downturn. It's a risk basically if you're not in the right location. It's a risk if you bought very, very high and your currency was strong and your currency is devalued and your property has not risen to the expectation of D. So in dollar terms, if you're investing and thinking, I'm a dollar reference person, argument's sake, in dollar terms, you might lose out. You've miscalculated basically your potential, the prices might change. Developers say, oh, it's become more expensive. Yes, you've acquired the land, but the price of putting a building on that land or a house on that land or amenities around it, planning law could change. A main highway could be allowed right next to your building. Suddenly your view of a lovely yard has changed to a 4-lane traffic, which would drop the price. So these are risks whenever you buy. Coupled with that, time frame. This is not an in-out transaction. You have to be, I think also you mentioned, patience is the word, and you need to do it with an educated, researched type purchase. Like before buying a car, you don't buy a left-hand car in a right-hand country. You buy the right kind of car. Yeah. You make sure it's got 4 doors. You've got a family. You make sure it's got the right kind of engine. You can afford to do it. So when you buy a longer-term asset, you need to make sure, does it have the right kind of bedrooms? You want to rent it. Who is your market that you want to rent it to? And I speak very specifically, in the UK, buying a 3rd floor flat without a lift takes away one full thing of people who are over a certain age who can't walk upstairs, young families with kids who need to carry groceries and a pram and their child up. They can't leave the child down and take the pram up, and you need lifts. So you need to make sure that you're buying something that's going to be what market are you trying to capture for that? Because you need to make sure you've got a very good target market. Who is that target market? That do they want a view? Do they want basically a concierge downstairs? Do they want basically windows of 5 bedrooms, 4? So all this basically affects what kind of rental income you're going to make. And I'm assuming good rental income also determines a good price move and therefore some gain for you vis-a-vis your other peer groups, which could be the buildings on the side. So choosing the right kind of development, having the right kind of research material, I think is extremely important. And ownership. So all these things you need to take care of because these are going to affect you. Liquidity, if you want to sell in the future, you need money. And this is a 10-year investment. How are you going to get money out of that without maybe financing if that's available? Is it cheap, expensive? It's going to cost you as well. So these are various considerations, I think, that I would look at. And our risks, yes, we won't know, but there are risks you need to be aware of. God forbid, there is another COVID 1 year. Can you afford to make those payments? Can you afford to keep your payments up and not lose the asset that you hope to have in 5 years' time or 3 years' time? So I think these are issues which are very real. They're very current. let alone the financial crisis which happened in 07, 08, 09, and other sort of, there is always going to be one of these events. It's just unfortunate you're on the wrong side of that event, but you have to make sure if you have a good asset in a good location, the price drop is always less than having a bad asset in a worse off location where they'll just drop through the floor. So, and having the right developer who can sustain sort of a 6 month or year problem.
Yeah.
That's a lot. I hope everyone is writing down notes, because these are like gems that Dr. Navid is dropping. Yeah, because yeah, I mean, for a lot of people that we talk to, they really don't know where to start. You know, all they know is that I want to get a return on this investment that I'm making. And sometimes the solution isn't always the most obvious one, because the assumption is always that this is the prime area, and so this must be the area where all the money is made. It's not always the case. It's not always the case. And I think the points that you have raised have just like emphasized that as well. Dr. Susie, what's your take on that? The risks of real estate investment.
I just like to pick on one point that Dr. Navid made, the use of the property. That's why you're in this market and you know what the approach has always been. I have a land, I've gotten some money, so I start to build. And usually I build to my taste and my knowledge. How I want to live the place. By the time you are done, you are like, okay, this area is now becoming a commercial area. I want to move out of there. So you built a home that is to your taste, not the taste of people who are coming to take over.
Coming to live there.
So you're converting a residential property into a commercial property. So it's no longer even a home, it is now going to be an office. And that office is to your taste. So if you have people who are coming into that space and are not aligned with your way of doing things, then you have your money locked up. So it's important to even appreciate how you even start to put money into the property. So if you are doing this thing straight away purely for investment, then the approach must be professional and commercial straight from the beginning. So you don't start something that is to your taste, and when you are done, you can't get your money out of it. There's the housing gap in our part of our world, so there will always be a need for more construction, be it residential, be it commercial. A lot of interest is now being picked up for warehousing and more shopping malls and all that. So there will always be the opportunity to invest in real estate. What makes it difficult for some of us is clients who are coming in with hard currency. So they want an investment opportunity that will preserve their currency. Everything we do here is in the local currency. So you bring in your dollars, you bring in your pounds, and these are invested in these opportunities. 5 years, 10 years, when you want to sell out, how much are you going to get out of it, in addition to all the returns over the period? So we have currency issues on our minds so far as real estate opportunities are concerned. So what we tell our clients is that align your investments to the type of assets that you are buying into. So if your funds are in dollars or are in pounds, make sure they are invested in things that you can sell out.
In the same currency.
So we manage the currency issue. But the another bigger issue for us here is liquidity. It's difficult to sell. It's more easier to buy, but very difficult to sell. It's very easy for us to pick up because most of the time we pick up during the developmental stages, so we have discount in terms of acquisition. But once you are ready 5 years, 8 years down the line, you want to sell, it becomes so difficult to sell out. So liquidity is a big thing. So once you appreciate the liquidity risk in property ownership, you should have that patience and be in there till you are able to. During COVID, for instance, I mean, there was the initiative to ask landlord or homeowners to defer rental payments. So for a whole year, we were encouraged not to request for rental payments for tenants. So who at that position where you can live off the rental incomes for a whole year and you are still okay. But if all you have is a rental income coming out of your property, then you have a major risk so far as liquidity or income is concerned. So the point we have been making is that real estate investment is a niche on its own. You need to have significant money first. You need to be able to put that money away over a long period. So patience is very critical. And you must understand the risk that comes with investing in the property. So just getting up and doing it by yourself may be good, but it comes with a lot of price to pay down the line. So talking to people who are already in there, people who have done some significant research and can recommend one area or the other to you, I think is the best approach to investing in real estate properties in Ghana.
Okay, thank you. We've talked about the risk. I mean, we never want to end on a downturn, right? So we'll definitely have to speak about the rewards. But before that, there are a few questions from the audience. So I'm going to throw it to both you, Dr. Susie and Dr. Navid. The first question was about public procurement. Explain how public procurement works in real estate and property business. And I'm tempted to believe that this has to do with real estate funds, crowdfunding. So if you could probably each of you pick one of them, real estate funds and crowdfunding, and explain how they work and how an individual can benefit from investing in such a vehicle.
Okay. Let me just speak on that point I made earlier. It's the absence of proper regulation so far as real estate funds or real estate trusts are concerned in our parts of the world. But luckily for us, we have the regulator, the Securities and Exchange Commission, that has introduced a sandbox regulation. So it's up to the market players to pick that up and begin to develop products that are linked to real estate. It does not even have to mean that the investments are directly in the property. They could be derived or held at the back of the properties. So we have those opportunities where we have a lot of shareholders that can invest in a regulated fund. When it comes to crowdfunding, it's also not formalized. It's mostly on the private side. So you have a group of friends or people who know each other, about 5 to 10 people who decide to pull their own resources together, and it's a private initiative. So these are initiated by people who know themselves and have decided to go ahead to come together for something. But we don't have it on a larger scales where you have a government supporting a crowdfunding effort so far as real estate is concerned. But another space that is also coming up for us is affordable housing, because we are in the markets where the high end, it's so expensive. You have just a few people participating in that. So it's so expensive for a lot of people to come in. So there is the other gap that we have, which is affordable housing, which is also an interesting area that is coming up. So you have people who are identifying small plots of land in very strategic areas and are putting together properties that can be retailed at very low prices, $65,000, $50,000, to the middle level income. So those are also opportunities that are coming up for any form of crowdfunding where real estate investment is concerned.
Okay, all right. So yeah, Dr. C, I know your answer was probably specific to Ghana, where we don't have those, formalized, I call it institutions or funds yet. So probably maybe I'll shift to Dr. Navid, since you have worked in other countries, how would crowdfunding work in such a space? And is it possible sorry, I was just going to add, is it possible for, I live in Ghana or Nigeria, could I invest in a crowdfunding in Dubai, for instance?
At the moment, so I take them into two. So crowdfunding as one collective concept, and fund or funds holding real estate as one collective concept.
Yes, two separate concepts.
I think they're two separate. I think the key in any investment is to make sure that the asset manager or the person or the individual or the entity that's basically going to take our money, say this group of people on the call, our money, and go invest it in an asset. First of all, who is that asset manager? What is the experience of that asset manager? Because you have to give it, it's a given that if you don't have the legislation, you don't have the regulation, you don't have the governance or the oversight, then basically you'll have, for every one good, you'll have 9 rogues in the market. And your money goes in and you won't see where the money's gone, and it's gone away. So you need to, first of all, I think legislation, regulation, governance brings a certain level of transparency to the transaction. It brings up certain well-known developers, and I use not developers but an asset manager. Don't forget, the developer is at a conflict. There's a conflict of interest between the developer and the asset manager. If I was a developer, I want to get as much money for my buck. So if I am developing, my cost is $1, but I can sell it for $1.25, I've made 25% on my return. But if I'm also going to be fund managing, then I basically I can also make more. Let's do 150. So my view is that you have to have an experienced, well thought out asset manager. And whatever they're buying basically has to be an asset. Because don't forget, you have acquisition costs, which are costs to buy. You've got management costs, which are the yearly running costs, which are taken away for that asset that's being managed. Because when you own something yourself, you don't pay anyone. You are basically receiving the income yourself or the gains yourself. While you are doing it through a fund or a crowd sort of concept, you have to basically pay someone to do that service. It's a service someone is providing. So there's an acquisition cost, there's a yearly management cost, and there's always an exit cost. And there's certain clauses typically that if you are selling, you have to sell to the shareholders first before you go to a third party. There are various covenants within the agreements that can restrict you from sale. So crowdfunding, I think, is a new concept. It's a few years old, or where basically you need to raise money, and it typically is to raise money for projects, ideas. And so from a property perspective, I think crowdfunding is still very, very, very new. I think it's from an asset management perspective, as Dr. Susie mentioned, a group of 10, 15 clients of hers, we find an opportunity. Guys, let's all put in $25,000 each. We'll acquire basically something for $250,000. We'll have a nice strict sort of memorandum of understanding around our investment. We'll all buy one company. We'll all own equal shares in that one company. Dr. Susie will manage it. She will charge a fee for it. It's professionally done. And you know the asset is going to be done. It's diversified enough, and you hold that title. So I think there is a difference between crowdfunding and an actual asset management. One is crowdfunding is to raise money, a ticket size, to be able to afford a certain ticket size. But I would say that you have to have, the key in all this is, who is the asset manager? And does that asset manager have the professionalism and the insight to buy the right asset, manage it efficiently, cost effectively, be able to give you back returns that you want in spite of charging? Yeah.
Thank you. Abbas, that was your question. I hope it's been answered. Definitely there are avenues, but at the heart of it is having an asset manager who knows what it is they're doing, so that your investment is guaranteed, but not guaranteed, at least is growing, and you can meet your investment objectives. So thank you for asking. We have another question from Emmanuel. He is asking, what will be the best form of funding for real estate investment in our economy? He's Emmanuel Forrest. I'm assuming this is Ghana, where banks are only interested in giving loans to traders. Are banks not interested in funding real estate because real estate is high risk?
I think the challenge in our parts of our world, sometimes it's not even the mortgage, it's more of the matching fund. So you want to acquire something worth $100,000, you need to be able to bring up close to about $20,000 to $25,000 yourself. So that is always a challenge in going for mortgage. So if you're not able to raise that, then the opportunity is no longer available. We also have our mortgage that is priced in hard currency. And we live in a part of the world where we have stability issues so far as our currency is concerned. So you have a dollar-backed mortgage, which you must be paying back on a monthly basis, and you have a dollar rate that is not stable. So the pricing becomes something so exorbitant for you. By the time you are done with your mortgage, you are more like 3 times, 4 times what you took. So I think mortgage is available, but it's the pricing and also the matching portion that you have to raise yourself to be able to have access to that. So I don't think it's a situation where the banks are only, of course, every bank and their objective for setting up. If the objective of the bank is not to do mortgage, you won't get mortgage out of that bank.
Yeah.
So for those who are set up to do mortgage, it is more of, and for them, location is also very critical. And the need or the use of the facility is also critical. Are you living in there or are you acquiring it for investment? So all those things inform what can be done. So the best is to approach the bank that has resources to fund your need, and then you are able to get the facility. And you must also be in an income earning job that
Yeah.
you know that your income is guaranteed and there'll be no break in terms of expected inflow. Because the moment there is a break, then there's the challenge of you continuing to finance your mortgage.
Okay. All right. So
Can I make one point?
Yes, you may. Yes, you may.
So as Dr. Susie was mentioning, I think whenever you take credit, and this is coming from an experience working in the UK and doing mortgages for our clients there and in Dubai and Pakistan, just seeing. So I always advise clients that whenever you are looking to raise money through a mortgage, and as Dr. Susie said, find the right bank. I would also do some research and find out which bank is providing the facility to the developer who started the business, because they have a bit more understanding of the project. They know, they've taken that risk already, and you can remove the risk from the developer to yourself, basically without changing much of the credit risk of the lender. So I would do that research as well. If they are a sort of a mortgage, but don't forget, credit for development is very different for mortgage for end use. There are two different credit cycles. There's affordability issues, there's suitability questions. And as Dr. Susie mentioned, as an individual, I would prepare a 3-year cash flow, basically a net cash flow, that what my affordability is. I would do an asset and liability statement. I would keep that ready for my lender. I would ensure that I have a debt servicing cover. So typically when people give mortgages, there are two options. In certain countries, you can do interest only mortgages. In certain countries, you have to do capital repayment. So if age is on your side, it's not on mine, but on other people, younger people's side. If you take a 25-year mortgage, typically from a bank, or a 10-year mortgage, they would like to see the loan or the facility amortized over that 10 years or paid off capital and interest. And it tends to be equal payments every month for the 10-year period or whatever. So make sure that affordability, as Dr. Susie mentioned, is absolutely critical. If you are salaried, it's easier because they see that you've got a history of being working and you're an upwardly mobile job. Or if you're self-employed, you need to have at least 3 years of history that you've actually made money, you actually can afford it, and you are typically 1.5 times debt service cover is an absolute must. Without that, I wouldn't go borrowing money, because you will be up to your eyeballs basically in debt. And the lender does not care. They'll come after your property. You'll be harassed. It's stressful if you can't afford. So why go through that? If you're prepared for it, borrow less, do it cleanly. Don't go for that 90% mortgages. I remember in the UK, and this is a testament to why you should not do it. There was a company called Bradford and Bingley. It was basically a very well-known company doing mortgages. They were giving 120% mortgages. So you bought for 100, they were giving you 20% more to basically go for refurbishment or go buy your furniture. Now that is a very aggressive. And then that you had the market crash, people went into negative equity. The bank, they went and left the keys at the bank and said, we can't afford to pay you back, keep the property. So everyone lost out. Yeah. So I think you need to go to a responsible lender. It needs to be suitable and it needs to be affordable.
Yeah. And I think you can never run away from the research.
No.
You can never run away from it.
Yeah. Exactly.
And have to convince the lender why they should give you that money. Yeah. It has to make financial sense to them as well. Yes. Yeah. Abbas, yes, we will be recording this live, so it will be loaded up onto our YouTube channel after this. There was another 2 questions. I think Dr. Navid, you talked about buying right, like buying at the right price. How does a potential investor know that they are buying at the right price.
Okay. I think like we've all said, I think everyone's agreeing. So research means you have to have done some review, you have to have an opinion. You have to have a view as to what you feel this new development or existing development, what's next, what's going to happen the next 3, 4, 5 years. So there was always this 10, 10, 10 rule, 10 days, sort of 10 months, 10-year kind of thing. What's going to happen to my investment? And if you basically, the challenge was, I remember years back, there was a development that came up in the UK called One Hyde Park. And One Hyde Park basically was built by the Qataris. It was a very, very large project. The square footage, 1 square foot was £7,000 a square foot. Now multiply that by whatever the city is trading at, or whatever basically the Naira is trading at.
That's a lot of city.
It's a lot of city. It's an absolute ridiculous amount. So people who went in said, can they go from 7 to 10,000 pounds? Probably not. But the building next door, because this building had come up, there were 2 buildings either side of the new building. That was where the opportunity was, because those automatically, because of being closely associated or by association and being literally a stone throw away, they got elevated. Not that their views changed, not that their common areas changed, but it actually just rose because of that there's potential that a developer might buy that building, knock it down and rebuild what is next door to basically make 7,000 pounds again. So you need to be smart and anticipate. It's always not the shiny, glassy sort of thing in front of you. It's probably what's on the side, where there's probably a bit more opportunity. And that you can't be emotionally attached. As Dr. Susie said, it's not yours. You're buying this to basically make sure you get good money return, safe investment, and income. And it has to be something, whether you're developing it, you're doing it, do it for the market, do your research. What is my target market for renting this, or will buy this after I finish it? Commercial, residential, single family, multifamily, people coming from abroad back in, what kind of age group, what kind of income bracket, and you develop accordingly. And I think that is important. So you have to, I don't think it's buying the most expensive because it's made money in the past. They say there's no guarantee for the future, but to try and spot is what is the next one that will actually do well. The next best thing. I think that is where you make money. That is where it's safer. So it's even if prices change, you are basically not losing as much as the one that you bought at the absolutely prime and prime. Everyone's running after it.
That makes a lot of sense. That makes a lot of sense. Dr. Susie, the next question is for you. This person has an investment fund, and what they want, investment club, sorry, and they want to know how they can take advantage of real estate opportunities as club members.
Okay.
What would your advice be to them?
One of the services that we offer is management of investment clubs. What we try to do is to help them align their investment objectives to what they do. So I can speak to such a group and try to understand their objectives for coming together. We help them put them into a proper structure. If it means registering the club with Registrar General, we do that for them, so that the dream goes beyond just a group of people and it begins to explode and becomes very big. So those are the groups that we attract, and we help them pull their resources. If it's a regular investment they want to be doing over a certain period, we guide them to do that, and those pool of funds are aligned to some specific. So for instance, if it's real estate they are interested in, then we guide them in terms of selection and everything that they do. So it's a service we offer. We can speak with them and guide them in blowing up their investment club dreams. Yeah.
Okay. I like the idea of formalizing things. Like, I think sometimes to reduce cost and to run away from costing like that have to do with things like this. Everything is just based on, because I know you, let's do this. But things can sometimes, become very messy in the future. So it's always good to have a set of rules, a legal backing, that even if you're friends who are now enemies, you are bound by the set of rules. It happens, it's human nature. You're bound by the set of rules that govern the association, so that no one is, left out or cheated or whatever the case may be.
And I mean, if I could just add that, I mean, there's a lot of potential in real estate, and like Dr. Navid has mentioned, and like I've also mentioned, we are looking for expansion in terms of the asset selections for our clients. What we typically have over the years are what everybody knows: treasury bills, treasury bills, treasury bills. That's what we all know in our part of the world. Our stock markets we know exist, but it's highly illiquid. So engaging on the stock market is not as attractive as engaging in a larger market. So we are looking for opportunities to introduce innovative products for clients to participate in. And as I say, real estate is not limited to direct investments. You can still participate in real estate through an indirect approach. Your desire is to have real estate as part of your portfolio. So creativity comes in so that it's easy for a lot of people to still participate in and enjoy the benefits that are in there as well.
What are some of the strategies an individual can use to build like a steady real estate portfolio?
Well, it starts with research. I keep coming back to that. It starts with aligning with people who have already done it before. In Ghana, we have huge developers that have been in the real estate space for long. We have Traco, Reggie Manuel, Apollonia City, Clifton Homes, Buena Vista. There are people who have done it over the years. So there's nothing like approaching them to understand if you want to take it on a bigger scales like that. If you don't, then you attach yourself to institutions that are also venturing into that space. A lot of people are also doing it on a boutique or boutique level now. So you can also look at those opportunities and align in there, because real estate always has an upside. In our part of our markets, real estate prices hardly come down. They always go up. I mean, the returns are usually between 10 to 15% on an annual basis. If you understand the maths, then you have to be in there for a minimum of 10 years to get your money back. Significant on it. So if you understand all these metrics, then it's easy for you to begin to see the opportunities that are in there. So you need the money. You don't need too much, but you should be able and avail yourself to participate with others to take advantage of
others who know who've done it before and know what they're doing.
Yeah.
Dr. Navid?
I would agree. I would say there are these schemes that people have put together, and it depends on regulation, things called collective investment schemes. So collectively, you gather like-minded people. I think having the right kind of investment approach, everyone putting in $25,000, $30,000, $40,000 to come to this magic figure of 300, 400, 500, or even larger. And then either you buy multiple, you buy single units. And like you rightly said, if friends today might not be friends tomorrow. So there has to be no emotional attachment. It has to be a pure investment decision. Go to a good fund manager, make sure the documentation is done by a leading law firm. The accounts are filed every year. If there are taxes to be paid, make sure they are paid. So it's very black and white. How to efficiently own that asset. Should a mortgage be taken? Can a mortgage be taken? Because collectively now you're more people. Is it financially viable to borrow money to do it, and therefore you need less equity so you can leverage up and buy something larger? Is that affordable? Is that part of what the collective sort of investors would like to do? I think that's a better approach, as Dr. Susie mentioned, to invest in countries where maybe you don't want to take a $250,000 risk yourself in a I use the word speculative investment, but you can do it with a group of others, reduce and then do what we always call in our business, diversify your portfolio. So diversify your property investment portfolio. 25,000 in scheme Accra, 25,000 in scheme Lagos, 27,800 in scheme Johannesburg. And that's the way you collectively can put your 100,000 or whatever you want to keep in 3 different locations. You can do 3 different locations within Ghana, within Nigeria, separate developments. So you diversify from developer, you diversify from what I would call jurisdiction or geographical risk. If you want to hold that purely as in your portfolio as an investment. Your house is separate. That is something very different. That's you need to consider the different things what you do. But as an investment for real estate, I would consider it like, why would you buy Apple today, or you might buy Tesla tomorrow, or might sell something else? Same thing, diversify across industry, diversify across usage, diversify across location and across developer. And I would do it through a fund scheme route, so you can use smaller chunks to basically risk manage, for want of a better word.
So diversify to manage the risk. And then based on Dr. Susie's maths, I mean, if you've invested in the right property in the right location, based on the principles that have been shared, from 10 years onward, barring anything like COVID happening or any major economic catastrophe, you should be laughing all the way to the bank and still have your property. That's the beauty about real estate. Not only do you get your money back, but then you still have the assets. So it's continuously making money for you. We have three more questions, and then we would wrap up. So I'm sure I know the answer to this, but I'm going to throw it to our panelists once again. Which is better? I know what you're going to say. Which model works best? Building to sell, or buying to sell, or building or buying to rent? Dr. Navid, what are your thoughts on that?
Okay, so I would say, if you are building to sell, so if you are building yourself, you buy your own property, you have a good quantity surveyor, you have you can manage your costs, you can manage your costs per square foot. It is the most efficient way, and you have the time to basically manage that, and you're going to be there on site. You just can't say, oh, then so here's $100,000, please go buy me some plot and go build.
Yeah.
That's not the way. So if you're willing to invest time and do it yourself. So if the question means, should I be building myself, buying my plot, identifying my plot, making sure I get the right kind of plans approved by the local council, making sure the architect's good, keeping my cost down, having a quantity surveyor, that is because you control the cost yourself. You have full transparency. There's more return. And you get it right. You build for the target market that you want to sell. You don't build for yourself, as I think Dr. Susie mentioned earlier on. So that is the I would say the and then you can either sell it or rent it, depending on your target market. That is I would say the most from a value perspective, the most value you can buy. If you're buying from a developer, it takes the hassle. You don't have to be there. You trust the developer. You've seen I think some names are mentioned in the region. You've seen what they've done in the past. You've got good reports from friends. You've got good press reports. There's no legal cases going on. No one's suing them that their windows fell out or whatever. Then that basically means that you're paying a premium for someone else who's making money already, and you're not seeing that. You're going to make money after they've delivered that product to you. So when you do that, basically, it is sometimes the risks are different. I think the risk, if you do with a good developer, the risk is different, because you say, hang on, I'm not making that much money, but my risk is a good developer. He'll give a good product. He's already done his research, or the firm has done their research. I'll buy into it, and because it's a developer, probably I can get a nice mortgage if I need it, or I can get 5 friends and we do this collective scheme, but the returns are lower. So I think it's a risk return conversation. The higher risk, buy your plot, manage it, do it yourself, be your own project manager. It's the best return, but you'll be probably gray hairs faster than you can think, stress as you will not imagine. If you're not used to it, it's very tough. It's not easy dealing with the daily labor issues, and they put the bathroom the wrong way around, or pipes have been put in but they're all blocked. These are issues which the developer does not give you, that they take that stress away. And that I feel would be my take. If you can handle the stress, the risk, the returns are higher on buying, building and selling or renting than the other way around. I don't know, Dr. Susie, what your thoughts are.
There's always, I mean, I'm an accountant, so there's always a cost to you trying to do certain things by yourself.
Exactly.
I will always pay the professional to get the results for me. And from where I sit, I'm very passionate about the use of the property. What was the objective for you putting that property up? Was it a residential property? And if it's something you are doing by yourself, you are doing it to your taste, what you know. But by the time you're done, your taste is not what the market wants. The market wants something else. So if you are putting together a residential property, but somehow by the time you are done, the area has become a commercial area. So now you want to change the use of the property, then there are some risks involved there. But if you engage a professional from the start and you have good project manager in there, you are able to manage the cost in areas that you did not even anticipate. So I will always go for professionals and engage them. And like you said, trying to project manage construction, especially in the part of the world, is a lot of work. It's a lot of work.
Yeah. And what I would add to it, Emmanuel, and I think both our speakers have alluded to it, whatever you building to sell or building to rent, the objective is for the end user. So you need to understand what's happening in the market. Is the market looking for properties to acquire, or the market is looking for properties to rent, whether it's a short lease or a long-term lease? It's very important to understand the space you are building for, because at the end of the day, that's your objective, to either sell or to rent. So it's very difficult to say one is better than the other. The one that works best is where the market is or where the market is going, because there are, if you're selling the property, it's gone, it's not yours. If you are renting it out, you still have the ownership. So you also need to align that with your objectives as well, in addition to where the market is. Okay. So we hope we've answered that for you. Ni Aite is asking whether there are any tax benefits or breaks when one invests in real estate. We talked about the taxes, the property tax, the capital gains tax. So are there any reliefs through investing in real estate? Probably on a general level, and they're probably zone it into Ghana specifically.
From where I sit, I know about the income tax, the rental income, and then the capital gains tax. Once the property is converted into a commercial one, those taxes apply immediately. It only becomes interesting when you convert it into a trust and it's gifted out. Then you are able to defer the tax on it. But if you are converting the property straight away into a commercial one, then your rental income kicks in, your sales income kicks in, and that is when you begin to pay. So it depends on the use of the property as well.
Okay. I know specifically in Ghana too, the amount if you take a mortgage to buy a property, the amount you pay as repayments can be a before tax deduction. I'm not an accountant, but something like that. So that amount can be deducted from your salary before the tax is applied. But the caveat is that you can only use it for one property. It has to be your primary residence and one property in your lifetime. So you need to be very, cautious as to, making a demand on that relief, because it's a once in a lifetime opportunity, and you should have taken a mortgage. You should be taking a mortgage to acquire that property. So that is one tax relief that I am aware of as well. Okay, so final question is, what are the recommended exit strategies for real estate assets? Exit strategies. How does one cash out?
Well, I think it's important for every investor to have their own exit strategy. For some people, 50% return is enough.
Yeah.
It's about time for me to sell out. For some people, 100%, 200%, 500% is what they are looking for. And by the time you hit your 200%, the market is coming down, and then you have all these surprises. So it's important for everybody to have their exit plan. You've put in 100,000. At what point do you think you'll be able to conveniently come out? So if it's taking 10 years for you to have 100% return on the investment, at that point, Are you ready to sell out completely and take all your gains and walk away? Or you still want to keep your principal in there and just live off the rental income? So the strategy actually depends on the individual and why they have put money in that particular property. So maybe by the 5th year you have done 50%, but there is another opportunity that could even earn you more. So you're exiting at 50% and taking advantage of something else. Or you stay in there, you hit 100, 200, but in our part of the world, people like to buy and hold. It's the usual thing, even with equities. They like to buy and hold because we don't keep our eye on opportunities, we don't keep an eye on potentials that selling out of this or taking the gains out of this to buy into something else is a better approach than holding on to one forever and looking for the highest level of return you can ever get on that.
Thank you, Dr. Susie. Dr. Navid, what are your thoughts on this?
I would totally agree. I think there's the unanswered question always when you invest. How I don't use the word greed, is probably a strong word to use. But when you start seeing returns, if you say, oh, I'm getting 20% this year, maybe I hold out one more year and then more 20. And then inevitably, as Dr. Susie mentioned, you hit a bad year and those 20, 30, 40% gains can erode in a matter of days, months, weeks. And then your buyers wait because they know they're like sharks. They're also, don't forget, your buyer becomes your next investor. So if I'm buying today because I've taken advice from Navid and Dr. Susie, and so I buy today, tomorrow there's somebody else say, hang on a minute, the market's gone. I'm going to wait because he's suffering. He's got a mortgage to pay. He's probably lost his job. He'll drop his price. So there's always someone in the market who's going to be totally against what I feel I want to sell. So I always would advise clients in whatever investment you make, you need your exit strategy has to be surrounded about your return. What return do you basically, are you comfortable? If you've said, I'm happy with a 10% return on my investment, 10% is when you reach it, come out and look at something else. Because if you always follow that, oh, I'll get 20 today or 25, you'll get caught out somewhere along the line. Because that word, strong word, greed will filter in somewhere, and you say, hang on, I'll miss the opportunity. You'll be blindsided. You'll be totally blindsided, and you'll basically stick with it. And there's always someone in the market, and one should always believe, who knows more than you, has more money than you to invest, and will always basically be able to get your property if they want. It's where the way market balances that way. So I would always have a very disciplined approach. Know what your asset allocation would be, how much you want to allocate into property, how much of that property you want to do speculative, how many you want to do long term, and each exit strategy should be around the return parameter. Do I want, in my speculation, I want to get 9, 20, 30, I put in more money, I was going to risk more money, so I need more return. So that's the build yourself, go do it, sweat in the sun, do it yourself. Not many people want to do that. It's a very different strategy, but it has a different return aspect. Then using the more saner approach, using a professional, a developer who knows what he's doing. Say, if I make 10% return, I'm happy with my investment, I'm out of it, providing my currencies remain neutral, providing my lifestyle has not changed during that 1 year or whatever, during something else has not happened, which might have changed my investment objective. So my investment objective is key. And my return objective comes from that investment objective. And you have to be disciplined and sell it, move on, do something else.
Thank you so much. Thank you so much, Dr. Navid. We do have a comment here from Floxy D Global Ventures. I answered, but I just want to, in case you missed out on my answer, just send us an email to Cecil, and then we will have one of our advisors speak to you. Since your question is to your specific circumstance, we're happy to help you. So we will definitely be in touch with you after this. So that concludes our questions. This has been a very interactive session. I mean, so many things have been shared. I said, I hope everybody was writing notes, and I wasn't joking when I said that, but in case you didn't, this video will be uploaded onto the Cecil YouTube page, so you can always make reference to it. Major takeouts, research. It's really, really important. Real estate is no different to any other investment. I think probably the only difference is sometimes we place too much of the sentimental value on what it is that we're doing, and we lose sight of the intended objective, right? So the important thing is to, one, research, have your objectives. If this is something that is difficult for you to do, there are professionals who are available to help you. CESO is available, and as you can see, we do have added expertise that can share their knowledge so that you're making the right decisions for yourself. Concluding thoughts from Dr. Susie and Dr. Navid before we end this session. Okay. If you could say only one thing to the audience who are all looking to invest in one way or the other, what would it be?
Real estate constitutes a significant portion of our portfolios. So it is something that every potential investor must look out for. And when it comes to real estate, location is very critical. Upside potential is very critical. And in our space, convertible use is very critical. It should be something that can be converted from one use to the other one to take advantage of whatever is available at the time. If going in directly will be a challenge for you, the recommendation is to look at alternative. Come together with a group or invest indirectly through a fund and still be able to take advantage of it.
Thank you, Dr. Susie and Dr. Navid.
Yeah, thank you. First of all, Nanswa, thank you for getting the forum together. It's, I think, been for me an eye-opener as well. I've learned also in the session. I would always say, as we've pointed out, so research, as you mentioned, using professionals. So someone like CESO Global, someone like Octane DC, who are local in the market, who can assist you, help you, price it correctly, put together other like-minded investors. So I might come as an investor and maybe Dr. Susie has 5 others. She can simplify it, saying, listen, we all can put in 25, 30 each. Let's go look at a project. So try using local expertise and local knowledge and in a professional capacity. I think that basically what I can say is that you then have more transparency. You probably make the right decision in the right location for the right property. I think there's nothing better if you're sitting outside the country or you're sitting inside the country, but it's not your main job to look at real estate. You're actually working for an oil and gas company. Let the professionals do it for you. That is, let them asset manage, as they say. Let them be that digitized, like you guys do at CESO, a marketplace, if I use that word, marketplace of like-minded, property-related lawyers, accountants, developers, opportunities in property. And then someone like Octane DC, who can basically probably put a structure together locally in. I would always value that much higher than trying to go ahead and do it myself and going blindsided and basically be either ripped off or lose money and then never have the courage again to invest.
Thank you so much. Right decision, right location, right property. Thank you so much, Dr. Navid, and thank you also, Dr. Susie, for sharing these wonderful principles with us. Thank you also for everyone who joined this webinar. I hope it has been informative. We're all available. Like I said, this would be shared on the CESO YouTube channel, and you can contact us at CESO for any advice you need regarding investment, whether it's investment or for your residential home, anything related to property, we are available to give you that help. The YouTube channel is CESO Global. So if you just search that into CESO, our page would come up. Thank you all so much for sharing your time with us this afternoon. And on this note, we say farewell. Thank you all and enjoy the rest of your day.
Thanks a lot. Thank you all. Bye-bye.
Thank you. Bye.
Bye.